Hey guys, I trust you are all well and you've had a good week. So what I want to just go through, yesterday was, well, the past 2 days I've been having a good look at the market. It's pretty cold here. It's cold in Johannesburg, so excuse my warm clothing even though I'm indoors. But my voice is a little bit raspy, but we'll get through nice and easily. I want to show you a few things that happened in the past couple of days, but primarily today, there is something that we hadn't looked at in great detail, which is where do you place your stops? Stop placement is absolutely critical. For me, it takes into account, or it confirms your understanding of probabilities. Remember, I always say at best, even when everything looks crystal clear to us, only looks crystal clear to us because we are in the 60-40 zone. 60% of the time will be right, 40% will be wrong. We just don't know when the 40% will come in. Out of 100 trades, 40 will go against you. You will get stopped out. And that's a key part. You will get stopped out. You just don't know when you're going to get stopped out, right? But you get stopped out. The other, 60%, 60 out of 100 trades, 6 out of 10 trades, you will make money. And depending on what the market is doing in front of you, you will make optimal profits. Or you will make maximal profits. Remember, I've said optimal profits is our earliest profits. When you look at our measured moves, leg 1, leg 2 extensions, and we say, well, there's the earliest profits, take profits there. But if in the market to watch it. That's optimal profits. And then if the market moves in your direction, well, you can just continue to scale in and build a position. Interesting enough, we're going to talk about stops, but I want to have a good look at where we are today. I also want to just have a macro look at the two markets that we are trading. Talking about building positions, we probably have covered this before. Have a look at this. Today I'm like, what is that? Is that a cat with cheese, or is that a mouse with cheese? Because I've managed to get MT4 open on my MacBook, my MacBook Pro. So I'm quite chuffed with it. The only disadvantage, which is not too bad actually, because I'm pretty used to my MacBook Pro, is I don't have a mouse. So I can use the finger pad, and it works quite well. But this is a clear chart. Hopefully, we won't have any of the other problems we had. For some reason, on my other laptop, my Samsung laptop, we kept on getting those funny messages on Zoom. So hopefully, this will be a clear presentation. So just quickly talking about building positions, I can't resist myself. If you were to jump into the market, let's say you're taking a trade here, and you're taking some profits. I'll forget about these red and green. That's today's setups. You could have scaled in here, breakout, pull back to the 10 EMA. You could have initiated a new trade or built, added your position up here, and come out of the market at some stage. Markets are fractals. So whatever we see on the daily chart, we can see on the 5-minute time frame that we trade. It might occur over a few what do you call it? Over a few sessions. And if it does, if you're in the market, you're in the market. Hey, John, how you doing? I must say, really appreciate just seeing you guys come back on. I really appreciate that. Thank you very much. There's also, some guys who log in, I think via the YouTube channel, etc. They talk to me independently. So greetings to all of you. Quick question, sir. How do you actually place our trade on the 5-minute chart? All right, I'll come back to that shortly and show you how we actually place the trades in. All right, so in terms of just the daily study, we want to talk about stop losses and how to preserve our capital. So you must learn to take profits. If you don't take profits, market can turn against you. As a classic example yesterday, where there was a reasonable enough setup on the 5-minute time frame, but you would need to have gotten in when it's set up, and you need to have taken your profits at optimal level. Because if you hadn't done that, when news comes up, remember I say whenever the news is coming up, don't initiate new trades. If you're in an existing trade, make sure that you got your stop loss at the correct technical level, because you might get stopped out. So if you hadn't done that, you'd have been stopped out quite magnificently. But if you'd taken your profits at the correct level, well, everything would have been fantastic. You'd have made some good returns. So we'll have a look at that shortly. So low of yesterday, high of yesterday, and that's what's happening today. Now, we kind of spoke about this last week, that we ought not to be as surprised. I mean, if you look at these dodgy candles here, that's been happening the past week or so. All it means, market goes up, gets to some level of resistance and turns and goes through the open of the day and gets to some level of support and turns and ends up somewhere near the open. So multiple reversals. Who knows when they occur? They may occur with a sudden news breakout. They may occur over the 3 sessions. But when you're seeing that quickly on the daily, don't get fixated by saying I'm just going to go long and long and long the whole day, or I'm going to go short the whole day. I mean, clearly on the daily time frame, you can see the dodges being created, trading ranges being created. It simply means the market goes up, market comes down. So we're looking for possible reversals, be it reversal to hit a level of support or resistance, or major trend reversal. And we've spoken about all of those in the last 7 months that we've been presenting on this weekly show. Now, the other thing we said as well is this bear breakout, okay, is dominating, controlling the market at the present moment. Why would we say that? Remember, so we had a trend in here. That's a long-term trend. There was, of course, another trend within a trend there, broke beneath the trend line. Okay, so broke beneath the 10-moving average. You could see now weakening of bullish momentum. They've been able to hug the 10 EMA, break beneath that long-term trend, attempt to break beneath that, closed at the 20 EMA. We'll see what's happening at the 20 EMA. Then they closed beneath the moving average, another close, moving average, an attempt to, just like we did here, to go back and close above, failed inside, then we had a breakout. So breakout, of course, the breakout candle follow through, etc. So that's controlling the market. And a couple of weeks back, we said, well, you got to be asking yourself, what is the market likely to do? Okay, on this time frame, or if you see this kind of pattern happening on your 5-minute time frame. So always, you must just automatically, when you see these things, just put in a measured move. There is a breakout beneath that to there, or you could just say, okay, the breakouts are there or there, it doesn't matter. What it affects, of course, is your profit targets. So the computers will see that, of course, The breakout could have started there, and there is the long-term profit target if the bears are able to follow this through. But we also look at other things, right? Now, remember, we've kind of covered this before, but you can always ask questions as you go along. Insert. Want to see if this is the first leg of a move. Okay, so there is the first leg of a move. And when we get a pullback, that you can see, okay, there is a pullback kind of ended. Where is that second leg likely to go? And you would have thought, well, okay, if the bears are strong enough, they will resume the selling, and that's where they would want to go. But of course, as we can clearly see in this case, the bears were not able to just resume straight, bounce off the 10 EMA failed. So there's been some buying that's been taking place. But of course, we know if the market cannot hold back at the 10 EMA, which is a good indicator for us for the strength of this particular move, we've got to wait and see what happens at the 20 EMA. That's what we get. Now we're going sideways. So at this point in time, what do you think is happening? Have the bears capitulated? Are the bulls in charge? No, the bulls are not yet in charge of the market. There's other things that we can look at. Well, at the 20 EMA itself, we've only had a couple of closes, 3 closes above the 20 EMA, but no strong bullish strength. So I'm going to take this off. Okay, remember, this was high of yesterday, low of yesterday. Let's just remove that. Okay, so at this price level, we're going sideways. Now, why would the market be doing something like that? Well, you always look to the left. At some point, we had a bull breakout. Bull breakout followed through fantastic, and we came back to the 10 EMA indicator of strength, decent low test, and the market turned and it could have carried on. So at that point, that's a key turning point there that gave us a higher low for the bulls. So the market comes back to test that. It was a significant level of support, above this, a test above this sideways price action. Market has come back to test that. So it's not a surprise for us that is happening until we see strong bullish breakout above the moving average, above this trend, and you follow through. Then all we are saying, this is still a pullback to this bear breakout. Okay, what else will be significant? We haven't spoken much about the 50% pullback, but that's another significant level that the market tends to look at. So when you have a breakout, 50% pullback is very significant. We've touched on it before, but not in great depth. So the market is coming back to try and test the 50% of that breakout. So all you got to do, if you trade in this, if you see this kind of pattern on the 5-minute time frame, hourly, 15 minutes, whatever you trade in, just wait. There is nothing for you to do when you see this kind of pattern on the time frame that you're trading. If the bears are so strong, well, they're going to test that. But what are you going to get? You're going to get the resumption of the breakout or of the bear move, another leg that will come, that will then resume here, close beneath the moving average. There has to be follow through, and then we'll start to look for opportunities. In that particular case, we know that our pullback is kind of extended all the way back here. Okay, so there's a pullback. Is it 1 leg, 2 legs of the pullback? What it does is just says if you do initiate a trade, there is the potential target that the market wants to go through. But it's not a surprise. It can't be a surprise because we have this level here. So with price action, there is just so much information that we get given that starts to make sense. So if the market is trying to create a second leg that would get us to here, will that be a surprise for us to take optimal profits here if you're trading the daily time frame or whenever you see the chart? No, it won't be, because you clearly have a level of support that's down here. I mean, that really is I think is quite incredible. You know, it almost looks like I'm jingling the market to show you this. You know, so there's the first leg. There's the extent of the pullback. If the bears are strong enough, they're gonna want to put a second leg down here, and that's gonna go to that level. And that level is exactly within a few pips if you do it down. But that's, you know, double bottom that we had there. So that's a significant level, 1676, that the market may want to go to. So if you start to see a bear breakout here, then you're going to have to take the trade. Now, using this particular chart, where will your stops be? I mean, I cannot overemphasize stop placement. So we're pretty clear about where to take our profits, take optimal profits here. If you can manage it and try and get to the maximal profits, fantastic. You might get a breakout and continuation, then you start your whole assessment again. But where would your stop be? I've said a lot of times, stop must always be at a technical position. So anytime that you take a trade within here, okay, your stop has to be above here. That's where you got to put your stop. Anytime you initiate a trade in here, that's where your stop is. It can't go, it can't, you can't say, well, listen, I'm taking the trade here, and that's a pretty big candle, so I'm going to put the stop here. That is not the correct place. The only way you can lower your stop is if the market starts to track downwards and we get a decent enough bear breakout and we break beneath these lows. Here, we tried to break beneath the low, we failed. Okay, if we had broken beneath the low, closed beneath it, had follow through, had a pullback, and started going down again, then your stop could come to this level. But until you have a strong close beneath this prior low, your stop has to stay there. So if you do get a setup in here, bear breakout or a bear candle pullback, whatever you get in here, okay, you do not put your stop here. That is not, you're going to get stopped out more often than not. You're going to get stopped out more often than not. So if that does happen, then we need to, well, that shouldn't happen. Your stop has to be here until you get any close beneath here. If you get a strong close beneath here, that's just a bear candle closing beneath here, a couple of them, and we get another pullback, and when the trend resumes, then we can put our stop here. Stop always has to be at the correct level. I mean, if we if we have a look down here, okay, double bottom, and let's just assume initiated a trade here. You're not going to put your stop here. That's not the correct place. Your stop has to be down here beneath the double bottom. That's where the stop goes. It can't go anywhere else. Well, you know, you can put your stop wherever you want, but that 60-40 is just going to get skewed. You're going to get stopped out more often. And you're only going to get stopped out and say, but why am I getting stopped out when the market goes in my direction? It's got nothing to do with your assessment of the market. It's got everything to do with how you're managing your risk. Okay, it's tempting to put a tight stop in the market because when you work out your position sizes, hey, I can trade a lot more lots because I've got a tight stop, but you're going to get stopped out more often. Okay, or it just looks like, well, it looks like the market will not come back here. You don't know that, put the stop in the correct place. Now, I'll also talk a little bit about what else you could do, for example. I mean, you can place your stop here, 1 pip below, 2 pips below, it doesn't matter what you use, because you are saying basically the market comes back to this level and takes that out. I don't want to be in the market, because then I know my assessment was not correct, and I'm happy to be stopped out. I'm happy to protect myself with the stop loss. Could you put it much lower than that? Could you put your stop much higher than that? You could. Excuse me, guys. You really can get ultra conservative, and there's nothing wrong with it. So you could say, okay, I think I can put my stop here, but if the market comes back, it might bounce. I'm not comfortable. I've had a look back at my charts that it kind of bounces off by a pip or two and then takes me out and then carries on. I'm not comfortable putting -1 pip there. What then, do I just guess where to put it, or what do I do? No, you don't. Again, you got to look at the technical levels at the market that you look. This is a 2-bar reversal that creates the double bottom here. So you could say, well, I think this double bottom here is significant in the market, and that can create a measured move for me. So the height of that double bottom becomes where I put my stop. So I'm okay. I'll put my stop down here. I know the market might come back and maybe just go below this by a couple of pips. I'm okay with that. But I'm saying this 2-bar reversal that creates double bottom is a significant measured enough move, so I can put my stop there. Could also do the same thing. Remember we spoke about trading ranges. You could say, okay, that's a trading range. If I take a trade down here or down here, whatever, I take a trade, and if the market turns, what are the bulls likely to do? Or the bulls are likely to go for a measured move. That's how far a breakout is likely to go. So I'm taking the trade here. I'm 60% comfortable with my read, but I may be wrong. The market may want to just try a measured move breakout. It will be a breakout above the trading range. Most breakouts fail, but it can go to the extent of the measured move. So I'm gonna put my stop. Okay. I'm gonna put my stop just above the measured move. Because if I'm wrong, there might be a forced breakout, but it might want to reach a measured move. So I'm just going to put my stop there. And then I'll just wait for the market to come back, and I can still get decent returns out of my trade. But I've got to be patient. I really have to be patient, because if you're not patient with it, you're gonna close yourself out of trades unless, oh my goodness, George, I closed myself out of the trade, but it went my way. Why? Or because you kind of forgot that the market might want to break above that. Okay, so coming down here, you may use that, or you may say, okay, double bottom, and I'm going to take a trade. George says, with double bottom first seat, then take a trade, but I want to take this particular trade. It's major trend reversal, which is a 40% chance of success. Remember, we spoke about that, 60% chance to get stopped out, but in the 40% that goes your way, you can really make 3-to-1 returns if you manage it well. But so if I'm taking that, where do I put my stop? Because maybe you don't want to wait for perfection, because there's no perfection. But you're saying, hang on, if I'm wrong, there is still this trading range. And if there's a breakout beneath this, I think the market might want to get there. So I don't want to get stopped out of this 2-bar reversal. I'm going to make a choice to put my stop here because I'm deciding to take an earlier trade. If it goes my way, good. If it doesn't go my way, well, I get stopped out, and I'm happy to, gotta be happy to be stopped out. It's a difficult thing to allow yourself to, but you have to trust your stop. You know, if you don't trust your stop, means you're not trusting your assessment of the market, you're not trusting your own read of the market, and that presents problems. So why would you be more comfortable with where to take the profits and not be comfortable with where to place a stop? So, you know, I'm not going to measure it for you because on the daily time frame, it might be, oh goodness, look at all those pips. But you know, these markets are fractal. Same patterns will appear anyway. Not only will they appear on any time frame, they'll appear in any market. So this could be pork chops or avocados or whatever it is that you want. You won't know just without looking at the labels on the chart. So you could do that. So okay, I'm taking that. I'm going to put my stop down here because if I'm wrong, the market will not get a measured move, and then it might turn. Now, you could do that when you're trading a major trend reversal. That's where you probably trade less, right? So if I'm in a trend, I really like to just put, you know, my 1% and try and build up as we go along. But if you're trading a major trend reversal, and we've covered this, if you scroll back on on our historic record, you know, because it's a 40% chance of success. You know, I don't want to go in 1% if I'm trading a major trend reversal. Okay, and you know, I don't want to repeat what major trend reversals you get stuck. But if you were to put 1/3 of a percent, 1/3 of your usual risk in, and the market then tries to break beneath this, gets to measured to this level, measure move of that, you get you know, bounce off this hidden level of support, then you get a higher low. You know, I'm very comfortable put another 1/3 in, and maybe by the time it gets there, I'm already in the trade. But the point here is decide where to put your stop. So there's 3 points where you can put your stop here. A couple of pips beneath the double bottom, or you can say, oh, okay, this 2-bar reversal is a significant level that to the double bottom with this level here that we had. So I'm just going to put my stop a measured move beneath that. So that's another place you could put your stop. Or, you know, I mean, if you're taking the trade here, right, you're taking a higher low trade that you're taking here. If you do that, then I would only put my stop a couple of pips beneath here, right? But if you're trying to take an earlier trade, that's when you really got to just be a little bit more conservative, put your stop a little bit low and wait. There's opportunities to always build and say, oh, fantastic. You know, I got in now for another opportunity to get into the trade here, or try and get in the trade here, or get in the trade here, or trade here, or whatever it may be. In which case, if you had your stop down here, you can tighten your stop. Stop down here, you can tighten your stop to this technical level, not here. That allows you just put a little bit more lots into the market, and then just keep going on like that. Okay. So I think I've kind of probably messed this up on the lower time frame. But, you know, guys, just a couple of things. Keep this in mind in terms of where we are on the daily time frame. Don't be surprised with what's happening. Let's see if I can. Well, let's go to the euro first, and I'll come back and try and clean up. Okay, euro is quite interesting. We've spoken about this quite a few times, and it's kind of doing the things we spoke about. Remember, we spoke about that breakout candle, follow through, another follow through, pull back to the 10 EMA. So we have our leg one, that first leg, pull back to the EMA, and there is the leg two right there, just beneath that particular level. No surprise there. And then we also have the measured move of the breakout from where the breakout actually starts, plus or minus to about there. So optimal profits, maximum profits. You could also have a look at this. I mean, you could have said to yourself, well, if the market breaks beneath the, how far is it like to go? Does it give me enough room to find ways to get into the trade? Because I'm expecting that it will get down here. So if you trade in breakout strategy, you could take that because you expect the market to get there, but you need to hold back through all of this. If you're initiating a trade anywhere within there, that's where you're kind of holding out to go through. I mean, there's so many hidden levels of support. There's a definite visible level of support, which corresponds to that. Okay. And there's that level, there's that level, there's that sideways price action. So there's, I mean, when you get a cluster of these levels of support, you got to think of it as a very strong magnet, just layered and layered. It's trying to pull the market down. The market is likely to get to that level. So if you're in a trade, you just got to hold on and see what you do. Now, where would your stop be? Again, same kind of thinking earlier on. If you're taking any trade within here, okay, your stop correct place. Stop is going to be up there. That's the correct place to put if you're initiating a trade. You could be, in this case, once you've seen that we've broken beneath that level and we're pulling back and you initiate a trade there. When you see that, now you can put your stop here. So that would be fine to put your stop above there. Okay, pull back, I mean breakout, pull back, breakout, close beneath that, close beneath that, market returns and bounces off the 10 EMA, so you can put your stop above that. So if you're taking a breakout trade, you can pull down your stop and have your stop down in here. And then you gotta wait. So we don't have a very strong close at this stage here, but we do have after the market bounced off the 10 EMA again, we have a close. There's a close beneath that level. There's a follow through. There's a pullback. So if you initiate a trade here, okay, you can put your stop there at that point because of these closes beneath that low. Put your stop there, a couple of pips up above that. And I mean, I'll show you the other thing that we explored earlier on as well. Then, of course, I mean, you got to wait. If you get a pullback and come off at 10 EMA again, you can take a trade, still holding your stop above there. But, I mean, if today was to end up down here, you've hit your profit target. So really nothing more to initiate unless you're just trailing your stop to see how far we go. Okay. Again, the other thing that you could do, just to recap, you kind of saying, okay, I'm taking the trade here. Market may want to come and test that. So how else can I be conservative with my stop? Sideways price action, measured move. You could put your stop here if you wanted to do that. You could look at all of this and say, okay, I'm going to take a breakout trade. Market might just come back and create a double top here. And I want to be a little bit safe with my stop. Let me see. measured move with that, or a bit higher. So you could put your stop right up there. So the idea is don't randomly place your stops. You have to have stops in the market, but your stops have to be at a technical level. So just a quick look at the euro before we drill down a little bit further. So you kind of see, we've spoken about this, I mean, these measured moves, when you look at it, are pretty accurate. So these have to be in your toolkit in terms of deciding where to take profits, where the market might turn, where, it might, why is the market turning here? Well, this case now we know the market can turn here because of this low. It might want to test that. But already we've got so many other levels that are hidden here that to break through here, the bears have to be exceedingly strong. And how will we know that? Well, they need to put a strong candle, a couple of candles closing near the lows, breaking beneath this, and then pull back, test the 10 EMA, and if we see an opportunity, we can then look at taking that trade. So I want to go down, but before I do that, John, so if you want to place a trade, I don't want to forget your question, buddy. New order. Okay, so it's right up here on the MT4. So you always want to use market orders, and let me explain that. So let's say you're here, or let's just use this as an example. Okay, you want to take a trade here. You wanna say if the market breaks beneath that, then I want to be triggered into the trade. In other words, then I put a market order. But if price goes beneath this level, and that particular low is 1.18357. So, if you go 1.18347 beneath that, then get me into the trade. So all you want to do is go to new order. Then here where it says type, you don't want market execution because that gets you into the market straight away. You want to go to pending order. And then you have choices where it says type again. Okay, the thing that you should be looking at really is sell stop or buy stop. Okay, so you want to put a sell stop, then you just put in your price. I think we said if it was 1.18347. So you just plonk it in there, and you decide where your stop is going to be, whatever that level is, let's just 1.1. I'm just making this up as you go along. So that's where your stop will be. When you stop, then you've worked out your volume size based on your account, your percentage that you want to risk on the particular trade. I just use the position size calculator on babypips.com. I don't know if you guys use that. So if you go to baby, like little baby, babypips.com, they will have tools there. Go to calculator and just use the position size calculator. So once you've worked all of that, then you just hit place. When you hit place, then it's just gonna, it will go into the market and just hang around there, and it waits for you. Alternatively, if you're gonna put a buy order, then you use buy stop. That kind of changes to blue compared to red, so it's just a visual indicator for you. Place your order. I mean, of course, you have to work out your stop loss, because now you buy instead of selling. The price you want to buy at. You can also put an expiry. I don't put expiry. So I just want to have a look and see what's in the market. So you can put an expiry if you want to say, listen, if I'm not triggered in by tomorrow, then I don't want to be in the market. You know, you put a time in. So it's kind of that clever to do it that way as well. Okay, so I hope that kind of answers your question a little bit. What I want to do, excellent. Thanks. Okay, so an interesting world unfolded before us yesterday. Okay, that's the US session. Okay, that was a news breakout. So I you know, if you trade the 5-minute time frame, man, it's always good to look back after some news breakout and say, wow, if I had been in the markets, man, I would have seen this, I would have made a lot of money, I would have been happy, chappy. But trust me, the probabilities of getting it right are 50-50. So in other words, it's guesswork. I know a lot of guys have tried. A lot of guys will tell you make a lot of money on news. You can try it and see how it goes, but it's just unnecessarily stressful. So my view, before you get to red news, and you can find that on Forex Factory or whatever calendar you're using, that tells you red news is coming. Stay out of the market and just let it play out and see, you know, after a few moments on the 5-minute time frame. After 15 minutes, 3 candles, 5 candles, start to have a look and say, okay, as the market's giving me opportunities to trade, you know, because if you get a big move up or down, it kind of creates a bit of confusion in the market, and you want the market to settle down. And you can also see, I mean, all the way before the news, there usually is just lack of clarity within the market. So sideways price action, this is just, you know, you're coming into the UK session yesterday and kind of asking yourself, well, what is happening? Where are the opportunities likely to be? That's a measured move, and the measured move has been reached all the way in the open, and you can see, what was that? It's a 15 pip, maybe 20 pip price range from the time the market opens until we get this massive candle that occurred. I think it was CPI month to month or something, US CPI, that caused that. Now, you know, you could look at it and say, well, you know, I think the market was going down, so maybe, you know, if I had sold there, I would have made money. Well, if you think of it that way, why would you be ignoring this measured move? Because the goal of the market, you know, all the way after this was created was to get to this measured move, and the market got to that measured move. Then there was an attempt to break beneath that at this point. So we're here, double bottom. Market tried to break beneath that and failed. Then at that particular point, I'm trying to get smart with my mouse here. That particular point, after failing to break beneath this double bottom, as a failed break beneath double bottom, we created a higher low. Then we had a close above the moving average. So at this point, where is the market going? You're trying to get more information. So the fact this that happened afterwards should not entice you to try and trade the news at all, okay? Because you would have come out of your profits if you had been holding on to any trades, okay? If you had initiated any trade, and I'm trying to see where you would have, but let's say you had initiated a trade, your stop would have to be here, okay? Or if you've taken trades and you're holding on to your trades to see, let me see what's going to happen. I've kind of put in, I'm early. This is just at that time frame. Okay, I've initiated a trade. I know news is coming. I'm going to hold on to it and see what's happening. Well, if you initiate a trade and kind of say, well, maybe double top, and yeah, let me take a trade, and you've taken the trade. Okay, at this point, if you're taking the trade here, your stop has to be above here. If you initiate it anywhere down here, your stop is there. And then you're saying, I'm holding. You are taking the risk to say, I'm just going to hold the trade. There is no way for me, there's nothing for me to do until the news. I'm taking the risk with it. I'm happy to be stopped out. If it's a violent move, I might get slippage, in which case I might lose out more than my risk. So let's assume you did that and you kept your stop there. And you kind of look and say, okay, double bottom, that's time to take profits. I've taken some profits out, but I'm still going to hold it in case I get a big move. Market tries to break beneath that, couple of closes, pulls back, and we get that double top, and the market starts to trend downwards again. I'm now like 30 minutes before the news. What else can I do? Now, if you followed the rules correctly, you would have to pull your stop down here. Okay, we've now closed beneath this low. The market is pulled back and resumed. If you put your stop here. So you put your stop here. Tighten your stop from there to there and say, I'm going to wait for the news. Now, guess what happens? Just before the news, you see this. Chances are you've been stopped out, right? You'd have been stopped out of that. And then you saw this news breakout. Does it really matter? Well, depending on where you took the trade, you should be at break even or a small loss. Okay, in the way the market unfolded here, that's where you would have pulled your stop to. That's the correct place to put your stop. So I'm going to put my stop. I'm going to wait, or you get stopped out. That's fantastic. Then let's wait and see what happens. If you'd kept your stop up here, by anticipating news, it might go against me, whatever it may be, that's a different story. But the correct place would have been here. Now, what happens here? That becomes a question. Well, okay, I got stopped out, or maybe I said, let me wait for this breakout and see how do I jump into the market. Well, you see this massive news breakout, then buying comes back into the market. Then there's a doji, huge bull candle to test that breakout point, which fails at the 10 EMA. So if you are quick enough to be trading this and saying, well, okay, that's a news breakout. It is a valid breakout. It's broken out beneath all of this. There is an attempt for it to fail. Market comes to test the breakout point, and what else could be happening? Or it could be a 50% pullback. Okay, almost to the point. 50% pullback of the breakout, test of that off. Then I wanna jump into the trade. I wanna be quick and jump into the trade. If you make that decision to jump into the trade, the stop always has to be at the correct position. Okay, you can't put the stop there. That's not where you put the stop. Your stop comes up here. That's the correct place, correct technical place for the stop. So if you're initiating a trade here, that's where the stop has to go. And you kind of saying to yourself, well, okay, if I initiate the trade here, where can I take my profits? There is my breakout. Optimal level is here. So that's not optimal, it's maximum profits. Optimal profits, earliest profits, that whole thing could be a leg one. You can barely see here. Okay, leg one, up to there. I'll move it for you guys. Okay, so just follow this. So that's a whole leg one up to where the breakout ended. And pullback is up to there. Okay, so that's our leg one. There's our pullback up to there. So you're saying, okay, profits, that's where optimal profits is, almost the same. Now, for the measured move, I use the body, not the full, not the wick, because that's a failed breakout. So use the full body. So you're saying, well, that's where I think if I'm taking that, and my stop is there. And if I get there, that's less than 1-to-1. But I'm going to go for it and see, I might just get continuation beneath that. So you take that trade, and when you see that happening, you're saying, okay, I've already had my first leg, I've had my test of the 10 moving average. I'm expecting that the market will continue, but hang on a second, the market is failing. So people are taking profits right here. Do I close my trade, or do I stay in my trade, or do I rely on my stop? What do I do? That's the question you got to ask yourself. I've already had a test of the 10 EMA. Remember, with the breakout, we look for the first test of the 10 EMA. So I'm not expecting anything else at the 10 EMA. So might I wait? Okay, test of the 20 EMA. Okay, resumption fails. You're still relying on your stop. Okay. And if at that stage you say, hey, maybe I may be wrong, you get out with a little bit of a loss if you haven't taken the trade yet. Okay, but the correct place for the stop is there. That's where the stop goes. Let me just have a look at a couple of questions, make sure I answer them before we... All right, no, excellent. Do you want to go to a small profit? That's fantastic. As long as you're now clear about how to manage your trades and where to jump in or where to leave it, and see what happens. So we've had our 50% test pullback, and right here, I mean, you can see the market is turning. You're not actually getting to your profits. So ideally, if you trade managing, just get out of your profits. So if you wait and you see that, might take a little bit of a loss there. That's all perfectly fine. But then what do you do now? Now you wait. You got to wait and see what is the market doing. So there was a breakout point that's been tested. Now we get another test of that. So that's a double top, right? That's a double top that's formed. And you said, okay, double top that's formed. I mean, the session, US session, fantastic. I've seen the double top. I'm happy with it. All I now want is to get close beneath the moving average and then find ways to get into the market. Okay, so you get your close beneath the moving average. So you got two choices: take that trade or wait for the lower high. Okay, you got a double top, close beneath the moving average, take that trade or wait for the lower high. If you take that particular trade, same stop. Okay, stop is still up here. If you're taking the trade here. But then after we've had the close beneath here, follow through and pull back, and there's a low 1, low 2 test of the 20 EMA. And if you rather take that and say, well, that's a less riskier trade, I'm taking that trade, that point, your stop level is lower. So you can take that trade. Okay, and where are you going with this? Well, we have that level, but not just that level. Remember all the other things that we've spoken about. So we kind of saying, all right, so that's possibly the first leg of what could be two legs, right? So I didn't take a trade in the first leg, the breakout, but I'm taking a trade off this, the resumption of the second leg. So if I take that particular trade, I'm kind of aiming here, okay, to take some profits out of, take my profits out of the market, and let's, take profits out, manage the rest. That's probably the way to do it. So you take that and your stop is there. If you didn't take that for any reason, you kind of said, I'm not sure, let me wait a little bit more confirmation. That's a good low high to take. You get another opportunity to get in the market, you take the trade there. But because we haven't had a close beneath this low, you can't put your stop here. That's not the correct place to place a stop. Okay, stop is still here. So if you take that trade, your stop is still there. And still leg one, leg two, you're trying to get to here. And, if you want to see a lot more places where the market could go. Sideways price action, or, test of the moving average. Market might just want to make a major move of that. It's all coming down same. That's why when you see this pullback, don't be surprised with these things anymore. So, if you didn't take a trade in there, fantastic. Wait for the trade there. If you didn't take that trade, higher probability, but less profit left, right? Okay, so instead of taking that, you can take that, higher probability, but it's still aiming to get there. Fact that it goes lower, that's fantastic. You could manage your trade, take off a bit at the optimal profit and see how far we go. What else could you do? When you're looking to take let's go back here. I'm kind of saying, okay, where else can I'm gonna trade this news thing that George says don't trade. But I can take that, but where can I put my stop? Because although it looks beautiful, because it went bearish, could have been bullish as well, you could have been talking a different story. You say, okay, trading range, sideways price action, double top, double bottom, market might break above that and make a major move to test there. So I'm going to put my stop above that. Okay. And I'm just going to hold and see what happens. Okay. Fraction of risk. If I get stopped out, fantastic. When the market begins to move like this, you can tighten your stop and you can look to take additional trades in that way. So we got a couple minutes left. Let's see if I can spot something I wanted to talk about. Aha. Very interesting, very quickly. So yesterday morning, just going to do a line here. You kind of look and say, okay, double bottom. I'm looking for a higher low. So that's probably not at the right place. But let's do that. Okay, the news came down this way. So you say double bottom. I'm trying to find a way to get in. I now need to get a higher low out of this double bottom. I see a close above the moving average. Let me wait. If you put an order there, not triggered. If you triggered, stop is down here. Okay. Stop is down here. But you wait and say, okay, fantastic. There is my higher low. It's beneath the moving average, but I've had a close moving average. I'm going to put my entry above there, get triggered, it fails, but the stop is still here. Okay, so you just wait because you had a line on the stop beneath the double bottom. Or alternatively, remember again, you could have said, okay, if I'm taking a trade here, man, if I put a measured move, that's too much for me. I don't want to do that. But there's a bit of, you know, it can give me an indicator price action. Okay, this doji price action here, sideways price action. I'll put my stop here. Okay, so you could put it beneath the double bottom. You could put it here. Failed, you can then you wait, or then if you're in, you wait. If not, you can say, okay, I didn't like that higher low double bottom. There's another higher low double bottom. Let me take the trade, put it in, and you're not triggered, or you triggered, stop in the correct place, because you're working off the double bottom, trying to find ways to get into the market. Because if it goes your way, measured move might go all the way up there. So we do have sideways price action, and we're coming up to the news. So let's assume that you are in the trade. Okay. You know, you'd have wanted to be all the way up there with profits. Okay, if we broke above that, but we're failing to do that, market is not going away. But there's many other measured moves you can look at. Market might get to that measured move, or might get that measured move and you say, well, I'm getting to the news. I want to get out of the market before the news. So where else, instead of waiting for that optimal profits, which you won't have gotten into, where else can you legitimately take your profits? If you are in a trade, or if you're initiating a trade, before the news, you got to take your profits out here. Okay, and that's the point I want to get to. You have to take your profits out. You can't assume there is a decent setup for the bulls. Let me wait. Let me not take profits because it's for the bulls. I might just make a lot of money. You take your profits out. If it's going the bullish way, wait for the pullback. In this case, a point I wanted just to get to quickly, if you hadn't taken profits out, you'd have been knocked out of the market, okay, by this violent move during the news. That's why I want to get out before the news, because still made decent money, 2-to-1 or whatever it may be, 3-to-1, but you need to have taken your profits. All right, guys, thank you very much. Let me just check and make sure there's no last minute question here. Hey, fantastic. Just keep plugging at it. We've covered quite a lot in the past 7 months. So just go back to the archives on YouTube and, listen in and follow through. And let's keep trading the profits. Thank you, guys. Fantastic. See you next week. Appreciate all the feedback. Just keep working at it. Thank you, guys, back in the office. Much appreciated.